An annual investment checklist may sound mundane, almost boring, especially in a world obsessed with market predictions, hot trends, and short-term performance. Yet after decades of watching portfolios succeed and fail, I can say with conviction that boring, repeated review beats clever forecasting almost every time. An annual checklist is not about finding new ideas. It is about staying aligned with reality. It exists to protect you from drift neglect and slow behavioral decay that quietly erodes long-term results far more reliably than any single bad year in the market. The purpose of an annual investment checklist is simple but profound: to pause, step back, and ask whether your portfolio still reflects your goals, your life, and your risk tolerance as they exist now, not as they existed years ago when the strategy was first set. Markets move, but lives move too. Income changes, responsibilities grow, priorities shift, and time horizons shorten or lengthen. A portfolio that is not reviewed regularly does not remain static. It drifts often in directions you would not consciously choose if forced to decide again from scratch. The first function of the checklist is goal reaffirmation. Before looking at performance, asset allocation, or market conditions, you must revisit why this money exists. Is it for retirement, financial independence, education, legacy, or flexibility? Have timelines changed? Have new goals appeared, or old ones faded? Many investors skip this step and jump straight into numbers, which leads them to optimize for returns rather than relevance. A portfolio that performs well, but no longer serves its purpose, is not a success. Next comes risk alignment. And this is where honesty matters more than theory. Risk tolerance is not what you say you can handle during calm markets. It is what you actually tolerated during the last period of stress. An annual review asks, did recent volatility cause panic, sleeplessness, or impulsive decisions? If yes, the portfolio may be too aggressive regardless of long-term models. If volatility felt manageable and even presented opportunity, risk capacity may be higher than assumed. Adjusting risk is not admitting weakness. It is acknowledging reality. Asset allocation review follows naturally. Over time, winners grow larger and losers shrink. Without rebalancing, portfolios become concentrated by accident. The checklist is not asking whether you should chase what has worked, but whether current weights still reflect intentional choices. Rebalancing is an act of discipline, not prediction. It restores the portfolio to its designed shape, rather than letting markets decide it for you. Another critical element is contribution and savings discipline. Annual reviews are an opportunity to increase contributions. As income grows, adjust automation or simplify accounts. Many investors focus obsessively on returns, while ignoring the most controllable variable in investing, how much they consistently add. Over long periods, contribution behavior often matters more than asset selection. Costs and taxes deserve deliberate attention as well. Fees, expense ratios, trading costs, and tax inefficiencies compound quietly in the wrong direction. An annual checklist forces you to ask uncomfortable but necessary questions. Am I paying for complexity? I don't need assets located in the most tax-efficient accounts available to me. Have regulations or personal circumstances changed in ways that require adjustment? These questions rarely feel urgent, which is exactly why they are often neglected. Behavioral reflection may be the most valuable part of the checklist. How did you behave over the past year? Did you chase performance delay decisions out of fear, overtrade, or ignore your plan? The goal is not self-criticism, but awareness. Patterns repeat. Investors who reflect annually begin to see their own tendencies clearly, which is the first step toward managing them rather than being managed by them. The checklist also serves as a filter for new ideas. Instead of asking, "What should I buy this year?" a better question is, does anything meaningfully improve this portfolio relative to its goals? Most ideas fail this test. That is a good thing. An annual checklist reduces activity without reducing progress. Importantly, the checklist is not meant to be reactive to market conditions. It is meant to be scheduled. Markets should not dictate when you review your strategy. Life and discipline should. This separation protects the process from emotion and reinforces consistency. Over time, investors who use an annual checklist experience fewer dramatic shifts, fewer regrets, and more confidence. Not because they are smarter, but because they intervene at the right frequency. Too often leads to noise. Too rarely leads to drift. Once a year is often enough to correct course without overcorrecting. As portfolios grow and lives become more complex, the annual investment checklist becomes less about maximizing returns and more about maintaining alignment, because staying on track is not about doing something extraordinary each year, but about repeatedly doing the ordinary things well and understanding what belongs on that checklist, how to structure it, and how to use it as a decision anchor, rather than a to-do list, is exactly where we need to go next. By examining how to turn an annual investment checklist into a quiet but powerful discipline, rather than a rushed review, because the value lies not in the list itself, but in how calmly and honestly it is applied. A complete annual checklist should begin with life updates before market updates. Ask what changed in your income expenses, family responsibilities, health career risk, or time horizon. These factors matter more than market performance. If life changed meaningfully, the portfolio may need adjustment, even if markets were strong. If life did not change, restraint is often the correct response. The next item is goal clarity and prioritization. Reconfirm what this portfolio is meant to do and in what order. Is growth still the primary objective, or has stability moved up the list? Are there new near-term needs that require liquidity? Writing this down each year prevents quiet goal creep, where portfolios slowly shift toward performance chasing rather than purpose fulfillment. Then comes risk reality check. Review how the portfolio behaved during the year's most stressful moments and how you reacted. Did you feel compelled to act, or were you comfortable staying the course? If discomfort was persistent, risk may be too high. If volatility felt manageable and even presented opportunity, risk capacity may be higher than assumed. This is not about matching benchmarks. It is about matching behavior. Asset allocation and rebalancing follow naturally. Compare current weights to target ranges. Rebalance if allocations have drifted meaningfully, not because of predictions, but because discipline requires restoring intent. Rebalancing once a year is often enough to correct drift without turning the portfolio into a trading machine. Next is contribution optimization. Review savings rates, automatic investments, employer matches, and account usage. Small increases in contributions often matter more than asset changes. Annual income growth should trigger at least a review of contribution levels. This step compounds quietly but powerfully over time. Cost and tax hygiene deserve their own moment. Review expense ratios, advisory fees, fund turnover, and tax location. Ask whether complexity is earning its keep. Over decades, minimizing friction often adds more value than finding new opportunities. A crucial but often skipped step is behavioral reflection. Write down what you did well and what you regret. Did you chase, hesitate, overconsume information, or ignore your own rules? Patterns repeat unless they are named. This reflection turns experience into learning rather than baggage. Finally, consider new ideas through a narrow filter. Does any proposed change clearly improve the portfolio's ability to meet its goals without increasing fragility? If not, say no. Activity is not progress. Most years, the correct decision is to change very little. The checklist should end with documentation. Note what decisions were made and why. This creates accountability to your future self and reduces second-guessing. When markets test you later, the checklist becomes a reference point, not a memory. In the end, an annual investment checklist is an act of stewardship. It replaces anxiety with structure and impulse with intention. Investors who practice it consistently do not look busy, but they move forward steadily, while others oscillate between excitement and regret. Staying on track is not about brilliance. It is about showing up once a year, asking the right questions, and respecting the answers. If this framework feels useful, consider subscribing to stay with these long-form conversations, focused on discipline over drama, and leave a comment sharing which checklist item you tend to avoid most, because the item you resist reviewing is often the one that matters most.